Greg, thanks for having me. This is great. It is shortly after 4, and what I'm thinking is near the end of the day, we keep this casual. I'm really excited to share some of the things that we've learned over the last 2 or 3 years about digital securities, the technologies involved, the licensed entities that help enable the trade, and where we're at today, which is I think probably what everyone's interested in. Is it working yet? And I have some answers, and they're mostly good. All of it very optimistic. On the side in the chat, if you have any questions, I have someone that's feeding me some questions, and happy to field those as we go. Happy to stop wherever we're at in the workshop and answer those questions. So please feel free in the chat just to drop any thoughts and ideas and questions you may have. It is a fairly big subject. This workshop, actually, one of the ones I did took 4 hours, and I'm going to get this done in less than 30 minutes. Hopefully share a lot of information, leave you with some excitement, and leave you with some actionable tips. And hopefully you will consider digitizing your cap table, which is the first step. Let's get started. I want to leave a thought, and this may confound a few, and for those that aren't confounded, it may not seem interesting, or you may wonder, how is this relevant? I'm actually going to circle back to it throughout the workshop, but especially at the end, and answer this question. But I want to put forward a controversial statement, and that is that paper securities are securities, and those are the ones that held in the hands of brokers and investment and banks and so on, that were used up until the 60s and 70s. They were actually often bearer certificates, and whoever held them owned them. Electronic securities came along, and it made sense. It was a huge advancement forward. The ability to take warehouses full of paper and put them on a microchip, it was a necessary step. However, those are facsimiles and copies, and therefore not securities. They're also prone to be lost and stolen. So I want to assert an interesting paradigm shift that results as a natural consequence of us adopting this new technology, this blockchain-based issuance, this immutable ledger, distributed ledger type model that we're moving toward. And that is that we are now back to these things being actual securities. They can't be lost, they can't be stolen. And so we'll circle back in on that in a second. Want to next go to in some minds, a fairly controversial statement. Alan just said 80%. I think that's probably the smarter statement. A little bit more caution is always good. But the former chairman and CEO of NASDAQ made this very confident statement that 100% of the stocks and bonds trading on Wall Street today could be tokenized, and in 5 years, 100% of those will be tokenized. And I think that someone who's, I think the reputation is beyond question, someone that's able to make a statement like that, we need to take this very seriously. So whether it's 40%, 60, 80%, or even a full 100%, it's still a significant shift. And there's some pretty substantial benefits to the issuer and the investor, and even some of the ancillary service providers in the global financial markets, which we'll chat about in a little bit here. The foundation, just really quick, and Craig actually mentioned some of our world's first, and I don't know that it was intentional. I don't even know if it was smart, but we got some badges. We were very wanted to understand, and we thought that the best way to understand, there's no books out there on digital securities yet, the best way to understand was just to go do, and so we applied for several licenses and received a bunch. First, just a quick overview. We're a global digital financial firm. We are active in investing, distribution, and providing liquidity. So we have a venture capital team, a group of investment bankers that help raise post venture capital, post seed, and then a markets team that helps create liquidity and get liquidity for these digital shares, these digital securities. And we have funds that allow people to invest into a lot of these fintech initiatives that we have globally. Next, as I mentioned, the digital security offering, we were the world's first, the sole seed investor in the world's first, as Craig mentioned. We're also an investor in 3IQ, North America's first listed Bitcoin fund, which is pretty exciting. We are also an owner and a board member of a federally registered European stock exchange approved to list and trade digital securities. And since this deck was made, we became a shareholder and a board member of a digital securities exchange out of Africa as well, which is pretty exciting. our journey has been a long one. We've been around for a while. I don't think we have time to get into that. I think there's more interesting stuff to talk about. But just so you know, as Craig said, I'm a serial tech entrepreneur. I will gravitated toward the fintech ecosystem in 2015-16, and from there, as you can see, typical hockey stick curve. And I think as it relates to digital securities, the subsection of digital assets, I think that we're still in that deceiving time where the first 7 exponential steps you can't see on that exponential curve, but we're about to experience some very significant growth. Really quick primer on digital assets. I think everyone is probably understands most of this stuff. It's very simply said, it's a digital representation of real world assets. The existing asset classes will be digitized to build a more efficient global economy and trading system. One thing I think is really important to understand or appreciate is that we're not in the era yet of digital native where we're inventing these things, at least as it relates to digital securities. These are representations of paper, and these systems are operating in parallel. And a lot of people often think digital securities, digital assets, they get them confused and they think of CryptoKitties or Bitcoin. In this case, this digital security is a representation of a share. It's exactly the same as the paper share, except it's smarter. So, that's why many people call them smart securities. Dividends for investors, disclosures, and the stock splits and so on are just programmed into it. They're smart. They go, they work. They're much easier to administer. Digital assets are better. Again, for the sake of time, I think I'll just comment at a very high level. They're much more liquid. You can transact at will. They're accessible, so you can fractionalize to 18 decimal points. The example I give there is the Berkshire Hathaway share that's $280,000, which is intentional. It's a barrier to become a shareholder there. We can wrap that in a digital wrapper and essentially fractionalize that to 18 decimal points. So if the Berkshire Hathaway share goes to $1 trillion, you could still buy a penny of it, which we think is the future. It's global, so it's the only reason why markets don't, not the only, but the probably most significant reason why the markets don't exist very effectively cross-jurisdictionally. In other words, a Japanese issuer is not easily able to sell his early stage venture to an investor in Germany, a retail investor in Germany, is simply because there isn't software, hadn't been software, the ability to transact at a reasonable cost, that there was just significant friction to that. Blockchain is solving that. Compliance, proactive compliance, instead of massive onerous documentation requirements for public issuers. We've talked to several regulators who are actually excited about not having to pretend to read all that stuff and instead have a global view into the transactions within their jurisdiction. And instead of actually waiting 6 months after some bad behavior to investigate, they are able to scan and see where there may be some bad behavior. So they might be able to protect the investor before, or more investors before the bad behavior either starts or escalates. And transparency, definitive ownership, and an immutable record. We are in the era of billion-dollar bank fines. And we're going to be talking a little bit later about what's the difference between electronic and digital security? Why do we care? It works pretty well. These are things that people say, public markets work pretty well. They actually don't. They appear to work well. All those unnecessary costs are baked into the share price. We pay for them, just as buyers of real estate pay for the seller's cost for the agent. The exact same thing occurs. The thought that we should trust banks is at odds with the news, the daily news. These banks are constantly breaking regulations and breaking laws, and I think the amount of trust that we give them is absolutely unearned. Digital assets are secure. I just want to say this really quick, and again, this gets people pretty nervous. It seems spooky. It seems unnatural, and I would again ask why is the electronic version any different? Well, maybe because the custodians are slightly different names than people are familiar with, or maybe the idea that you are the custodian is terrifying. I guess I can appreciate that may be a bit unsettling, but a bit of education, a bit of information, I think that everyone can feel better about the situation. So the storage risks are extremely low. I think at this point actually solved for. Many of the custodians have significant amounts of insurance. The regulation, the full compliance. The irony is, or the incredible reality is that the programming of the digital share encourages issuers to be more compliant. They're constantly reminded of their investor obligations, which is fantastic. And then the technology, the enhanced rights, the ability to self-custody, the ability to trade without permissions, assuming that's compliant to do so, rather than ask permission from your broker. Which another thought too, to call into question the idea that a lot of jurisdictions, the laws essentially don't allow people to own their own assets. The securities are held with brokers. It's almost like the regulator or the government or the Ministry of Finance doesn't trust us to actually own our own assets. So it's like we have a right to, we ask brokers to buy things and hold things. It's almost like we have a right to the benefits of the things that we're directing others to buy rather than actually being owners. And that may sound like a subtle difference, but I think it's a profound difference. And I think it's time for us to own our things. Digital assets are significantly more efficient. Again, for the sake of time, really quick, settlement time, cost of capital. I'll leave you to scan that slide really quick. Global interoperability. They all have improved attributes, obviously, fungibility, recognizability, scarcity, durability, divisibility, et cetera. I think we've seen that in the utility token, digital asset, cryptocurrency, even virtual currency back in the 90s and early 2000s. The difference between the points that we traded or even the Farmville points that we earned was a lot of these things that we couldn't get our Farmville points out of Farmville. Therefore, those Farmville points weren't that valuable. When Facebook talked about creating its own virtual currency token and the fact that we could port it from Farmville to Mafia Wars, the interest in that currency went up significantly. So when we can make it more fungible, more recognizable, and more divisible and more portable, we're going to increase the value of those things. And so this is where we start to actually talk about digital securities. Without that foundation, though, I don't think that the rest of the workshop, the discussion, is really as sharply in focus as it should be. But the digital shares, especially in we'll say, there's nano cap, which is kind of like venture capital, and there's micro cap, and anything that's considered sort of small cap in the conventional markets has a capitalization of less than $2 billion, which is just an extraordinary scratch your head moment. Which is, who decided that small cap is $2 billion or less, and why? And I'm going to explain why. And it's surprise, the investment banks created conditions that were would not enable smaller cap companies to actually come to markets. But what we're trying to do is to solve for private markets first, to allow for more venture capital, small cap, micro cap, nano cap companies to come to market, to a much broader market, preferably direct access to retail investors to be able to sell their shares. And we don't see why they shouldn't be allowed to do that, especially assuming that regulations are upheld. And again, with the programming of the securities themselves, the shares themselves, and platforms having licenses and being required to be compliant, we don't think that there's any likely high risk of bad behavior. And so a digital asset background really quick, I think this is important to look at. Obviously 2008 Bitcoin and 2014 Counterparty and Ethereum. Brave and Bancor actually came on and really started to show the promise of what would happen if a store of value that was more commercial, more sort of equity based, was available. And one thing that we can take away, and I know a lot of you listening to this know all of this, and I'm saying some of it reluctantly to build the foundation for the digital security workshop, but also some comments I hope to make in there that maybe are somewhat novel and somewhat new. And one of the things that I realized as a serial tech entrepreneur and venture capitalist was that the ICO craze was a lot of securities fraud or non-compliant securities offerings, I guess is probably a better way of saying that. There were some scams. There were some bad coins out there for sure. But what it showed was a few things. Number one, there is an insatiable appetite for investment from the retail into equity-based projects. They want shares. They actually want to be involved. And I think that that's part two of the same idea, which is that I think that the new investor wants to be a part of projects that are meaningful. And you could argue that the ICOs were not meaningful. I think that they actually showed that they were meaningful. Whether the founders and the founding teams actually delivered on that is an entirely different different conversation. But people want to invest in things that matter. They actually want to be a part of things that matter. And I actually believe that access is not enough. Equity is what people want, and we need to allow people to participate on an equity basis as often as possible. So the ICO craze was absolutely critical to testing the market. How much money is out there that can go toward these cool, novel commercial applications? A ton, billions and billions and billions of dollars. So now here we are, all grown up, realizing that a lot of that cannot continue, should not continue, and that there's a good reason for investor rights. So we can complain about the regulator all that we want, but at the same time, and I do think that as in many jurisdictions, regulation has been corrupted to benefit the few. But the initial intention of investor protections is a noble intention, and I think that we need to get back to that. So really quickly to understand the decline of the IPO, this is in my first little session here with the NCFA's event. Someone actually made a comment that in India there were 18 IPOs in 2019. That is an absolutely staggering fact. And in the US, there's anywhere between 38 and 45 the last 3 or 4 years. Now the question, why? And maybe no one's stopped to think why. Maybe thinking, why do I care? Well, why do we care? Because, I guess in Congress with venture capital firms that are largely dominated by rich older white men that make investment committee decisions, that fund things, that then IPO through a handful of investment banks, we're really allowing a very few a very small group of people, we're allowing them to determine not just the products and services that we buy, but the reality, the implication of that is the world around us. And that is a somewhat startling, if not terrifying thought, that anyone, let alone a very narrow, slim demographic of people is actually doing this. So I think that the decline of the IPO is a significant, startling product of what I think are sort of some pharmaceutical situation where testing requires billions of dollars, and it's a huge moat for the establishment. The establishment in finance has created conditions that just doesn't allow for, at least in the U.S. and several other large jurisdictions, doesn't allow for entrants that are not unicorn-esque. And so we've seen actually people opt out. Some unicorns that have simply said this is unjust, unfair, we're not going to participate, and they've gone to a direct listing or reverse takeover to be able to sort of back into a public listing as opposed to using a bank, an investment bank, which had always been the way that it had been done. Now, as being in Toronto, I think global first. I love the idea of being a resident and citizen of planet Earth. I happen to be in Toronto. There's a lot of things about Canada I love, but there's a lot of things about other countries that I love. I'm not a nationalist. I'm for the people. One of the cool things, though, in Toronto is that Toronto didn't lose the art of the small cap IPO. And so Toronto does hundreds, and I think in the very near future, thousands will do thousands of small cap, micro, and nano cap IPOs because it, as I said, hasn't lost the art. It's been a sort of market maker. It's made markets for e-gaming and cannabis and crypto. And I think that it will continue to, with caution and responsibly, be able to facilitate a compliant securities offering in novel markets with small caps. And what we're going to see here in a second is that the technology that's emerged will be able to support it. The private capital growth and the illiquidity. So private equity, as probably most of you have seen and heard, has grown explosively, where we have people like BlackRock with trillions under management. And the returns have been staggering. And part of that's the economy, the global economy, the U.S. economy in particular. And it has been, not mismanaged, but sort of not really rigged, but it's not natural. I don't think that these private equity returns will continue over a period of time. But regardless, there's a ton of money right now that has been locked up in there, and it's illiquid. So I think that one of the best use cases, people are often thinking about digital securities exchanges like crypto exchanges and regular stock exchanges, and the ability to just, for anyone anywhere to be able to go in and buy anything, which actually is a fallacy that doesn't exist in public markets. But I think with digital securities, what we're going to see is Some of this starting to occur in crowdfunding platforms, and Alan from Token Funder has a really cool permission that it's allowing for the beginning of issuance in some sort of secondary market to emerge. But I think in the private space, it's much less efficient. It's much larger than the public space, and it's much less liquid. And so I think that there's a real opportunity to prove out a lot of these things and sort of migrate a lot of the frameworks and the systems over to the public side. You know, a lot of private capital also invests in the public side as well. So this capital growth and growing illiquidity, and I think people becoming less and less tolerant of that illiquidity, is putting a pressure on private markets to upgrade. So we're actively upgrading those in parallel with public markets as well. I'm going to skip over this, but I'm going to actually just not even explain why I'm going to skip over this. The ICO, obviously, like I said before, massive growth. And I think what we're trying to do is to take what happened there and ensure, you know, we can't ensure that companies aren't going to go bankrupt. That's just a part of commerce. It's part of capitalism. But we can ensure that they go bankrupt with full transparency, or the transparency required by regulation. And again, programming that into the share as opposed to having these requirements laid over a typical cap table and a typical set of paper securities. It sounds like a much safer model, and it is. Really quick, just wanted to show two slides here that really talk about the size of the opportunity. I think that we really struggle, humans really struggle with the high end of things. We're really good at sort of our perimeter and our family and our community, and we understand those sorts of economics, and maybe we look at city economics and maybe national, but we look at global. We can really bend our brains here, and you begin to understand the size of the opportunity. If we don't factor in any additional growth, and I know anytime you add efficiency to a market, the market grows. This is one of the coolest things, is that these stats, all these numbers that I've talked about and we'll talk about, are actually a fraction of what they will be once these efficiencies are begun to be realized. But right now, what we have is nearly $1 trillion, as you can see on this slide here, $1 trillion of ancillary service costs to manage the global financial system from issuance to trading. I would say at a minimum, a third to 2/3 of that is absolutely unnecessary with the new system, and I think that a vast majority of the remaining third is up for disruption, and I think that's going to occur. So we're talking about a massive opportunity, which if you look at the efficiency we'd have in the next 5 years adopting a digital security framework, I think you can double that number fairly easily. And again, just to bring into perspective, all the assets in the world on the left-hand side, 500 trillion. If you include derivatives, we're talking over a quadrillion. And a lot of these assets are traded multiple times. So we're talking about many quadrillions of dollars traded every single year in major jurisdictions. So on the right-hand side, in the security token or digital security market, we're talking about less than $1 billion of issuance and very little trading. But that's about to change, as we saw with the ICO era and Bitcoin really becoming a standard and alternative investment. We're talking about that very small, immature market is already several billions of dollars in trade daily. We expect the same with digital securities very soon. So the biggest global investors are entering the space. I'm just going to leave it at that. I think we're all aware that this is happening. And when I say the space, I'm talking about digital securities, not just crypto and digital assets and so on. Liquidity is the enabler. Alan and a couple others have talked about DeFi, flash loans, liquidity providers. All of this is happening, obviously, and this is going to be a big part of enabling these what appear to be sort of competitive stock exchanges. They're not going to be able to rely on the big boys to provide some of these services, like liquidity providing and market makers that are essential. Simply, to be frank, because of anti-competition sentiment, they don't want to compete against their current interests, which they don't know if providing that service may disrupt their core business. I think a lot of it comes down to education, and a lot of these people will come around over time, but we need to focus on bringing in more and more liquidity. If some of the big names come along, that's great, but what we're seeing with DeFi is we may not need major players. The people may provide the liquidity. We'll only have about 5 more minutes, and I've noticed there's not a lot of questions here, so I'll just continue really quick. Digital Securities, and I'll skip through this as well. We don't have time, unfortunately. The roadmap, really quick, initial structuring. The initial structuring is critical, and I think that one of the reasons for substantial failures beyond the obvious. One of the obvious was actually that not a lot of these issuers in the ICO craze were actually entrepreneurs. A lot of them were brilliant technologists that have no idea how to build a business. They have no idea how to manage the treasury, and for those two reasons, I think probably primarily most of those failed. I don't think a lot of them were disingenuous offerings. I think they were naive offerings, opportunistic offerings, but naive nonetheless. I think they thought that they were going to pull it off, and we've seen some of these lower end altcoins begin to rise, and again with the DeFi movement, we've seen some of these that we thought were off the radar now back, like Icon, ICX, and I'm starting to wonder if some of these ICO projects were determined enough actually pull it off and become major commercial applications in the digital financial world. So the initial structuring is critical. We need to actually take this seriously. What would we do if we were going out to raise $5 million Series A? We should probably do all of those things. And so I won't get into the detail here, but there's a lot of information online about how to create a Series A. You don't need to go out and get a Fortune 500 investment bank. You can talk to your investment banker friends. And I think platforms like Front Funder, for example, are starting to really mentor people and provide products and services on their platform that help them package up a nice offering. And I think that while right now they're focused more on seed level, just simply because the crowdfunding exemptions are not significant enough to get large Series A's going, I think that it's a good place to start. So perhaps more of a crowdfunding approach would be best. But that initial structuring comes down to, where's the idea market fit? First of all, where's the idea? Where's the idea market fit? Is there any traction? Is there product into the market? What does the founding team look like? What's their makeup? What's the cap table look like, et cetera, et cetera? Really, and then the ICOs near the end in 2018 started doing all these things. So anyway, you can't skip that step, that's for sure. Now there's five steps, and 2 is regulatory compliance. Surprise, surprise. That was the step that everyone missed in the ICO craze. I think, again, platforms like Front Funder, they're an exempt market dealer. They have a platform. They can help you not only create your initial offering of shares, your securities offering, but they can ensure that you're compliant. And they're happy to answer questions. And they actually provide services of filing with the individual provinces, your new shareholders. Regardless, your jurisdiction, you need to be compliant. You need to seek advice. I don't think a securities lawyer is the answer. I think a platform that has securities advice in that jurisdiction baked in is really probably the most efficient, cost-efficient, and time-efficient way to proceed. So actually, let me say that again. High-priced securities lawyers, not a place to start. And that's where a lot of people started in 2018 and 19. I think it's a good place to maybe end when you do your Series C. Perhaps bring some people, and especially if you're thinking cross-jurisdictionally or some sort of global offering, that's when you probably bring in a lawyer. 3, outreach and sales. These things don't sell themselves. And so again, I'll just keep using the Front Funder example, which I probably should have said before, for those that don't know, is a crowdfunding platform similar to Start Engine and Seedrs. It's not Field of Dreams. You list it and they will come. They don't. You need to market it. So, hiring a digital ad firm that knows how to do compliant securities offering is one way. Doing it old-fashioned, some marketing, some tweeting, Telegram, Discord, community management, and so on. But this outreach and sales needs to be compliant as well. And so the platform that you're working with should be able to help explain what some of the limitations may be, some of the things you can and cannot say, and will give you the ability to actually facilitate that sale in your jurisdictions. But I need to say it again, it is so absolutely critical to know that the issuer, meaning the startup, the company, is responsible for driving traffic, for driving eyeballs, for getting interest. And that, it could be podcasts and so on. And that is actually one of the hacks. If you're ever worried about a non-compliant securities offering, don't market the security, meaning don't market the investment, promote the company. And if someone finds their way into some sort of offering, then I think that that in most jurisdictions would be compliant. But again, check with the platform that you're working with. Digital security issuance, this is more of a tech thing. This is, again, the reason why digital securities have failed until now is because the providers, and I won't name them. I could if you want. If someone wants to ask me for names, I will. But they came along and said, hey, it's a token issuance thing, right? And we know that's not true. They thought that this was a problem that would be solved with technology. Back in 2017, they started talking about it. 2018, they came on the scene, several of them. And we have a bunch of security token issuance platforms that don't do anything other than issue tokens. The reality is that the technology needs to fit in with trading venues, which is, I guess, another word for stock exchange or an ATS, an alternative trading system. If this token can't rest with someone that's licensed to hold it, doesn't have, a CDS or a central securities depository to be able to store and trade, then you're not going to be able to facilitate the trade of that, which makes the share pretty much worthless. So secondary trading, enabling that, obviously working with the trading venue to get them to help you provide some liquidity and to allow others to buy your security and get in and out of it. And I think I'm being told that I'm out of time. I wish I had more time. I should have known that there wasn't going to be enough time. I am going to leave up here at the end just a couple of links. If you want to create a DSO, we've actually open sourced it. We can provide services. We can walk you through each one of those steps. Happy to do it if there's a fit in terms of the size of the company and the market of the company. Where to invest? My advice is just get started. Go buy something on a crowdfunding platform, number one. Number two, try to buy a security token somewhere. You can go to stomarkets.com to find some options. And number three, just think about the first objective is to digitize your cap table. That's it. And you want to issue your shares on a blockchain, and then you'll figure it out from there. You'll figure out how to sell them, how to do a primary offering, multi-jurisdictional, and how to get these in the hands of a trading venue to allow you to trade them. And if you want to invest with us, you can reach out to invest@exponential.io. I will leave it there. Back to you, Craig.
Perfect. JW, can you still hear me right now?
I can.
Perfect. So I'm going to ask you a couple questions myself here, if you don't mind. First of all, your decks and the way you present the information is fantastic. And I know I'm going to ask a question on behalf of everyone. Is your deck going to be available? I'm going to post the videos, but are you going to be able to share the deck as well so we can do that?
Sure. Absolutely. My pleasure.
Perfect. And another question is, I know you've been globetrotting all over the world and talking about digital securities, investing, making partnerships. Which jurisdictions in the world are leading digital securities today, and there you think they're going to catapult and command a presence globally in the future? And what can Canada learn from them? And then the second part of that question is, what's next for Exponential?
Well, who's ready? Who's ready? And that's the $1 million question. And I think Malaysia, Seychelles, and Gibraltar and Estonia are the ones that are most serious. And I just want to be very clear here that Gibraltar, for example, is an onshore to the UK. So it represents a massive market. 80% of the capital markets in Europe rest in London. Estonia sounds exotic. It's just another member of the EU, and it's providing access into that massive region. Seychelles sounds like a small little island. And I won't name some of the other islands that have tried to provide regimes that would allow for compliant issuance and trading, but it doesn't compare. This exchange there, Merge, is actually a member of the World Federation of Exchanges. It's the fastest growing stock exchange in the world, and it serves the world. Actually, so the World Federation of Exchanges is the big person group. It's where all the major exchanges get together and talk about exchanging. And then in Malaysia, they serve the entire ASEAN, so 600 million people. They serve that entire region. And so these are not sort of small jurisdiction, island jurisdiction, Banana Republic backdoor to larger markets. These are major players that will facilitate the onboarding of, I believe, global investors, and begin to I guess, reduce the distance between the issuer and the investor, which is our mandate. So to answer the second question, and I hope that first question, that answer was acceptable. It's a tough thing to map out and explain this emerging ecosystem around digital securities, but our core intention is to democratize access to fundraising and investing. We think that assuming that the government or the regulator is ensuring that the parties are legitimate and that there's sufficient safety, and most of that's programmed, we believe that the issuer and the investor should come closer and closer and closer together. In other words, the value extraction that occurs right now is removed, but also that the issuer and the investor, meaning the company and the consumer, are working together and not really just sort of kept apart and thought of as a capital provider and sort of a multinational corporation. We think that this relationship should be a lot closer, a lot more intimate. So the future for Exponential is really focusing on, because we understand venture capital. We have venture capital funds. We put money into really interesting companies all the time. We understand that next sort of raising of funds, like classic investment banking. We also understand asset management, fund management. We've had to learn that to manufacture funds, to get people, to allow people to put their money in and to be able to diversify the investments and create a safer option for this emerging market. The focus right now is almost entirely on markets. The focus right now is getting these exchanges, getting investors onto these exchanges, getting high quality assets listed on these exchanges, and investors interfacing with these exchanges and being able to buy, sell, trade really cool things that are inherently valuable. So that's going to be us for the next 6 to 18 months, is working very directly with these exchanges who are not business builders. And again, one of the hard reasons, or one of the reasons why it's difficult to explain what's going to happen next, is because these exchanges, they're very smart bankers and securities exchange experts that have a license, and the typical sort of approach is, I have the license and now everyone shows up. They don't know how to build that business, so we're going to help them build that business.
Perfect. Maybe this is the third question. Do you think that we're experiencing a brain drain, a company drain, because a regulatory environment and the ecosystem, quite frankly, is just forming, as it's forming a little bit slower than maybe the innovators would like? And what is, in your view, are we moving fast enough? And if not, what is your message? And I really like to get your thoughts on that brain drain, the entrepreneurial drain, because we all probably here on this call, work with a lot of different companies all the time. Raising capital is a never-ending resourced task and initiative, and kind of, it's a stab in the heart sometimes when you see these Canadian companies. They formulate, they have some great ideas, but in order for them to survive, they got to leave the country to do so. What's your thoughts there?
You're asking really good questions, Craig. Very difficult questions, especially if I want to answer in less than 2 minutes, which I'm going to try to do right now. I think that of all the major jurisdictions, Canada's doing one of the better jobs. I think of all the quote unquote developed nations, and collectively, they're not doing a good job at all. I think that Asia continues to outmaneuver, and that is, not to be an alarmist on the whole Asia versus North America concern that a lot of economists have, but that continues to be somewhat alarming and somewhat concerning. I think that given the fact, and I think that the U.S., we can all agree that the U.S. has taken the most, I would say, frankly, irresponsible position, where they're providing guidance through enforcement. They're allowing young founders to make critical errors and then essentially coming in with a heavy hand. I think not providing nearly as much guidance as they could have over the last 3 years. So this isn't necessarily just today. Was very aggressive and very. If their mandate is to protect investors, I don't think they did a good job. How's that? Now in Canada, seeing the OSC approve 3IQ for its application to put cryptocurrency on a major exchange or a manufacturer fund that allowed for that was pretty cool. And we do have a and hearing the announcement from Wealthsimple, and I know that, as I mentioned earlier, Token Funder has some novel permissions as well. I think that and I don't see a lot of that happening in much of Europe and at all really in the US, with a couple tiny, notable but slightly inconsequential exceptions. I think that Canada is doing an okay job, but I think it's doing an okay job in relation to a very bad job in the U.S. And when you compare that to like Labuan, which is the sort of free trade zone environment within Malaysia that is sponsoring heavy duty digital securities exchange licenses, and the global stock exchange GSX has a license, Fusan has a license, as well as actively listing and trading. And we've listed digital securities. These venues are trading now in a totally compliant way. And I've read all of the listing particulars and all of the exchange requirements in these jurisdictions, and they meet or exceed all of ours at home. So this idea that somehow there's looser regulations is not really valid. To answer your question, I do think that there's a slight brain drain, and ironically, really what people are doing is they're going global and they're registering companies globally. It's more of an economic drain, which I guess is the same thing as a brain drain. But a lot of these people are staying put in their cities. They're just creating global companies. And I don't think there's any evasion of taxes, but I think it naturally avoids taxes. And so we have a situation where the government is complicit in enabling an entire region, Asia in particular, to create a zone that economically excludes them, which certainly is not good monetary policy. And I don't think the Ministry of Finance or the Department of Finance would like that idea, but I don't see any evidence that that's not happening. And so, I hope it's not too late for Canada and the U.S. And I think there's more of a potential for Canada to adopt new regulations pretty quickly to engage that. But there's a possibility where this entire shift is a monumental shift, and the balance of power, economic power, transfers quite significantly. Now, I know there's arguments against that, and I understand and appreciate that. And I don't think we'll know. But I do think that there is an economic drain. I do think that there's, and these people are hiring global lawyers. They're hiring lawyers in different jurisdictions. They're hiring accountants offshore, so I think it potentially massively impacts us economically.
JW, that was illuminating. Thanks for that. Well put. I want to thank you on behalf of the attendees and the team at FFCon for sharing that. And we probably have enough content and slides there for a whole nother workshop. Love to invite you back another time. Maybe we'll choose that international destination we talked about in in the green room here in the control room. Yeah. So thanks, JW. Fascinating to hear the latest and greatest digital securities. If anyone has any questions in public chat, let them know, or connect with us and we'll connect you with JW. So that's a wrap, folks, for week 6. I want to thank everybody for their time and participation today.